the number one most interesting economic trend that I'm seeing today is the stock market shrinking. And nobody's really talking about it. And that's kind of the weirdest, little alarming piece that I've seen. But in a gist, the gist of it, Roger, is that from 1995 until today, so about 30 years, we're seeing that the stock market has retreated, contracted, and lost roughly 45% of its companies. So a massive reduction in the number of companies that are public in the United States and in the New York Stock Exchange and that want to go public because there's more companies than ever. So we're not saying there's less companies in the US. The issue is that the incentives and the interest in going public and staying public have reduced dramatically. So what we've seen and what we've been concerned with has been a lack of diversification where we're seeing now it's the most concentrated stock market we've ever had in history.
Welcome to Sterling Insights, Stand Out and Supercharge Your Assets, the go-to podcast for financial advisors aiming to grow their assets under management, stand out in a crowded market, and retain assets nearly forever. Are you advising high net worth clients who own appreciated capital assets? Do you want to help them sell without losing a quarter, a third, or even more of their hard-earned profits to capital gains taxes? Then this podcast is tailored for you. Each episode brings you the latest strategies and expert advice from leading financial advisors, seasoned attorneys, and experienced CPAs. Learn how to maximize your clients' wealth, minimize their taxes, and supercharge your advisory practice with actionable insights. Join us on Sterling Insights, Stand Out and Supercharge Your Assets, where you'll gain the knowledge and tools to set yourself apart and achieve unparalleled success in wealth management. Subscribe now and empower your practice for a brighter, more prosperous future. Welcome to Sterling Insights, Stand Out and Supercharge Your Assets. I'm your host, Roger Silk, and today we're joined by Nic DeAngelo. Nic is the founder of the Saint Investment Group, and they focus on real estate with a strong angle of fixed income. They have over 200 million currently in their portfolio, and they specialize in institutional grade real estate, again, with the angle on fixed income. Nic, and we're going to have a lot of fun with this, is renowned for his ability to simplify complex economic concepts. And I know a little bit about mortgages and fixed income, and they are pretty complex instruments. Nic is here today to share his knowledge of that and how real estate can help investors protect their wealth, achieve tax-efficient results, and secure their financial futures. Welcome, Nic. Thank you for being with us.
Roger, it's great to be here. Great catching up beforehand. And yeah, I'm excited to have some fun discussions today.
Yeah, so appreciate that. Everyone knows what real estate is. I think most people have a fair idea of what institutional means, but maybe you can start by giving us a bit of an orientation on where your guys are really focused.
Sure. So a little bit about my background to explain where we're at today. I was blessed. Well, really, I banged my head against the wall and got a job working for free with two family offices. And that's really how I kicked off my career. It was the wake of the Great Recession, and I wanted to work with the best people, learn from the best. And I basically applied over and over and over for two local family offices. And I eventually got that role. I leaned into acquisitions with them because that was the biggest opportunity at the time. And so what I found was something very interesting. The wealth was multi-generational. We're talking, many nine figures, and they had so much wisdom passed down from generations that they looked at real estate not just for the amazing benefits of appreciation and the amazing benefits of taxes, et cetera. They even looked at hard assets, hard real estate from the lens of income. through the generations, they were trying to build up that cash flow that they had coming in. They had a growing family. They had many things to support there, but that's what I leaned into with that in mind. So since then, what we've seen is Saint grew. We had some amazing success. We eventually started taking on asset management for a lot of these companies, and eventually took in outside investors on the LP side starting around 2015. So since then, our smartest and most sophisticated, most interested investors in what we're doing started asking for fixed income investments. They said, hey, there's rockiness in the market. Hey, we have some concerns, particularly around the COVID era, and especially more recently and more. We've seen that in the last handful of years. So the request was, Nic, what do you got that can pay something consistent, that's pretty rock solid given the environment we're in today? Our answer to that was a investment strategy based on single family mortgages primarily. So we have a unique tool in single family mortgages that's unlike anything else in the world. We have 30-year instruments that pay fixed income over that whole period of time. So on our side, that's what the most rock solid foundations of an asset class we found. We dig into the economics, an insane amount at Saint, because we had multiple deals along the way, buying distressed assets, even back in the day, that the economics really were what drove the deal. It was much less just about the purchase price and more so about the local market, the wider market, et cetera. So that's what we focus on today. That's what I think the biggest strategy is today. And that's where we find the biggest opportunities, finding the economic trends, finding the investment tools and strategies in the real estate world that match those trends where they're at that time. And I think there's a lot going on today that investors have a big opportunity for.
You're managing about 200 million now. Is that right?
Correct. Correct.
And that's mostly, is it partnerships? You mentioned limited partners.
Sure. So we have an investment fund. We have an income fund. And so that's the standard GPLP structure. Limited partners in that. That's the vast majority of our investors there. We also own my personal baby on the hard asset side. My absolute favorite investment, especially right now, is in industrial real estate. So we do own a good grip of industrial real estate properties, but the timing is a little more complex and the driver is a little more interesting. When we have discussions like tariffs, we have discussions like manufacturing and import-export reshuffling. I am on the sidelines for a little while until we see some clarity on those items as far as industrial goes. But mortgages, I think the skies are very blue, and I think we got 10 to 20 years of very strong fundamentals.
So out of the 200 million, how does that split between equity investments and debt investments?
Sure. The bulk of that's going to be previous equity investments. The income fund's a much newer tool that's the last, handful of years that we added that to the menu. So, but it's more of a market timing. We've been investing in mortgages for well over a decade, buying distressed mortgages, sometimes doing workouts with the property owner, et cetera. But packaging those up as an investment tool to run an income fund, we've been doing that for the last handful of years.
Got it. Okay. And are you running multiple funds?
We have one fund, which is the only fund we have is for our fixed income. It's our income fund based on the mortgage investing. And then we do syndications when the market timing is where we want it for industrial assets. So on one side, we'll have an income fund that's more evergreen. We can take investors day to day. And then we'll have targeted syndications that will come up. So a one-off here and there for industrial opportunities.
Okay. And so right now, if somebody was interested, what do you guys have that's available right now?
We have our income fund, which has been pretty attractive to investors in this market. We pay 12 to 14.28%. So much higher returns than a lot of other places in real estate. We have a great track record, et cetera, et cetera. So in this market environment where you have delinquencies through the roof in many commercial real estate areas, where you have the stock market that's had a bumpy road and erasing gains day after day, something that's consistent and that pays a little more than maybe 4%, which is what a lot of treasuries are at, is very interesting to investors. So we're happy to offer a tool that gives investors that opportunity.
So Nic, I think a lot of people might be listening and saying 12 to 14%. What is he buying? Maybe you can walk us through a few examples of the kind of assets that you would own in the fund or that you do own in the fund.
So that's one of the biggest questions we get. As a matter of fact, Roger, we get that question so much and among, a handful of others, that we just did a whole webinar on it. Literally breaking down, we show our spreadsheets, we go in, we show our due diligence process. We're buying to a degree there's some distress involved in these mortgages. They're non-performing to a degree. Sometimes they have completely missed payments and there's years where they haven't been making their payments. Other times they're a furlough situation during COVID where they missed maybe 6 months, 8 months of payments, and now they have a rolling balance and they can't get out from under that. So we buy these discounted from often big banks, sometimes community banks, in bulk, and work through it with the homeowners to modify these loans and get them back on track paying. So that's where it comes. We get a discount oftentimes 25%, 27% on average for the last pool we were looking at of loans. So there's enough margin there to make investors very happy. There's enough margin that we cover the things that we need and make, profit on our side. And, our confidence is high in them.
So these are mostly single family mortgages.
Correct.
Are they firsts?
We're not against seconds, but the vast majority are firsts.
Uh-huh. And what would be at a high level, what's the due diligence process?
So what I just went through and what we just walked through, it ended up being like a 2.5 hour webinar. We go through everything. First, you want to check property valuations. You want to make sure that just because a bank sent you over a tape of loans with, 1,000 loans on it, doesn't mean that they're all accurate in their evaluation. Markets fluctuate. Real estate is a local market industry, right? So especially single family, one block can be great, another block can be not great. Then we dig into the junior senior component. We don't solve for LTV anymore. Loan to value to me is really not the most target variable. We look at CLTV, the combined loan to value, right? Because we want to know what truly a break-even point for the homeowner is. So if there's a first and a second, we combined those to come up with a CLTV. Next, we're looking at things like bankruptcy. We want to know if there's a situation like that. Again, most of these mortgages are having some degree of problems.
So you're pulling a personal credit history on the borrower.
We're pulling in an extremely deep dive on every single mortgage.
And what's the typical ticket size or investment size that you guys would be making into one of these?
So every tape, just a big tape of loans, a big roll of loans, a big Excel sheet of loans is different. So every transaction is different. We're typically targeting property size around $450,000 to $500,000 properties.
And that would be the hopefully the actual current market value of the property.
That's right. That's right. Frankly, we have no interest in ultra luxury and we have no interest in ultra rural. We're looking at middle of the road, cookie cutter, middle class Americans that we can support, keep them in their homes. And we find the best success on that side. So it's partially selfish where we know that these individuals want to stay in their homes and want to keep their families in their homes. We're targeting owner occupied properties. So we're trying to stay away from, a third house in Aspen or something. We want to be keeping families in homes. They're more motivated to pay. We're more motivated to be able to work out a deal on that side. And we just find better outcomes that way.
Let's just take the 500,000 because it's a nice round number. What would be, you talked about combined loan to value, which that's basically all the debt, the face value of all the debt. I just want to make sure that when people are listening, they're not guessing at what we're talking about. Combined loan to value. So let's say there's a first of 250 and a second of 50. That would be the face value, not the price that you pay for it.
Correct. Our typical discount's 25 to 27% on the last couple transactions. So off the unpaid balance of the loans.
Right.
So we get a discount on those loans, which gives us, a long road to be able to get those back on track and boost returns quite a bit.
And those were typically originated as 30-year fixed?
Correct. I mean, we'll see some HELOC sprinkled in. That's certainly not our preference, but typically seconds, et cetera, variable. We don't want to do any of that. But if our perfect loan is a first position mortgage, it's no more than, let's say, 60 LTV or CLTV all in, because most of these are seasoned. They might be 8, 10 years old. And so
Uh-huh.
there's a degree of stickiness. You look at the mortgage market today, Roger, right? If you look at seven-ish as mortgage rates today, you have over half of Americans that are sub 5% in their mortgage rates. These are crazy numbers. So there's a lock-in effect that's very powerful in single family mortgages today.
And what would be an average coupon on your portfolio?
I'll give you this stat. Our yield hurdle is typically around 18%. We target 18%. And that gives us, and typically we beat that, we blow that out, but that's typically a target as we evaluate and underwrite. That below that, there's just too many things can go wrong, too many concerns along the way. And again, we don't need to make choppy deals in the market today.
So just walk me through, and maybe we take $1 million, even though I know it's bigger than your typical size. I'm just trying to figure out where that number comes from, the 18. So let's take $1 million and you double the 500, right? I'm not, don't take a big one, but take an average one, just double it so people can follow the numbers easier.
There's really a few numbers to compute here, and they all vary on every single deal. So I'm keeping it really general. There's the unpaid balance of the loan. It's how much on paper that individual owes on the loan,
Right.
right? And then there's legal fees that are typically associated with that, right? Then in
Well,
addition,
okay, so the unpaid balance is the original mortgage was principal balance was 500,000. They paid it for a few years. Now that balance is 450, but they missed some payments.
sometimes it's calculated all in, but sometimes it's calculated separately as legal fees, et cetera. Different states treat those differently and what you can and can't charge. So that's why they would be broken out. But
Uh-huh.
to put it simply, there's only a few buckets that you typically lean into. There's the unpaid balance of the loan, how much principal they have remaining. There's legal fees, whatever's associated with that. And then the last that we look at, obviously, is the interest rate. All those things are subject to change in a loan modification. We can adjust it. We can drop legal fees. We can have them put a down payment to get their loan back on track. We can adjust the amount of years remaining in the loan so that we can drop their payment to meet their budget. Oftentimes, many of the conversations are just saying, hey, homeowner, why aren't you paying? Right? Well, the bank wants me to pay 5 grand a month, but I can only afford 3,500. We go, okay. So if we can get your payment to 3,500 a month, and that might change your interest rate because now your credit's really bad, and that might change the amount of time you're going to pay off your loan because we have to add all this to the back end of it. But we got your payment to 3,500. You'd stay in your home and you'd be happy and you'd grow your credit and increase your credit. Would you be happy and be making your payments? Yes, we'd definitely be making our payments. It keeps them there, keeps them happy. On average, I think we have about 39% equity that our homeowners have in their homes. So it protects their equity in their homes, and they have a big reason to be making their payments every month.
Or would somebody at your firm be negotiating individually with each of these borrowers?
Yes, we're negotiating, working through it with the borrowers, making sure that they're comfortable, making sure oftentimes it's going through their financials with them, trying to understand what they can and can't afford. And then once we land there, very often they are very incentivized to be making their payments every month. So we're
Uh-huh.
really getting fine tooth with it.
And then are they paying you some kind of a fee for that, essentially?
No, we're not like a credit fixing or a roll up or anything like that. We just work directly with them and just kind of get an idea of what they can afford and what gives them enough breathing room to live with how much their income is, et cetera. I mean, many people post COVID went through huge, difficult situations with, maybe making less money, getting laid off, debt, et cetera. I mean, if you look at the economics of where the country's at, there's record debt in many spaces. So we're just trying to make it work for them and create something long term for us and our investors.
So what's the original issue rate on a lot of these mortgages is what?
Four-ish. You're
So,
talking interest rate around four.
and how much where does it end up in order to have your gross yield be in the 18 range?
It would depend on legal fees. It would depend on loan term and extension of how long that looks and the interest rate. But we're staying below market. That's typically our interest is if market's 7 for a new home purchase, we're trying to stay around like the 6 range is very common. And that incentivizes them to be there for a long period of time. And then when their credit's good enough and they can go refinance, we encourage it. I think that's a great opportunity for them, and it boosts our returns also.
So just for somebody who's listening to this and thinking, hey, I love the idea of 12 to 14, I'm still not seeing where it's coming from.
Okay. So let's say it's $100,000 mortgage, right?
Okay. Yeah.
And you're increasing the interest rate. So every calculation of returns is adjusted basically in every way, and an increased payment term, right? Increased payment period. So again, I have a 2.5 hour webinar on it. I'll just send it to you, Roger. But
Yeah, I
yeah,
do get that it's not just, we did start this conversation by saying it's not the simplest thing in the world. I
yeah.
do know a little bit about, and it sounds
It's
like
always tough to talk accounting. I'll put it that way. But
you're
again,
squaring the complexity because you're not, I mean, straight off the, hot off the press, newly issued mortgage to a pristine borrower is still a complicated instrument. I get that.
that's right.
So I'm not necessarily surprised that I haven't figured it out in 20 minutes here.
I'll tell you what, I'll just send you the case studies. How about that? And
That sounds great.
yeah, you can see exactly multiple case studies that we have. I walk through 4 exit options. I walk through refinances, what happens, and how do we make money if they refinance. I'll show you a full payoff. They made every payment that they've agreed to. I'll show you a foreclosure scenario, and I'll even show you a wonky one, just as a nice little
Okay,
bonus there.
great.
So we have a
Yeah.
full breakdown, full financials, all that. It's just really hard to go over accounting, verbally online, but I'll send you the whole thing. And, if you want to post it, and you have a 2.5 hour webinar that everybody can go through. But our yield hurdles typically about 18%. The examples I'll send you, we typically average around 20 up to maybe 22% with some of these refinances where we get paid off early. Sourcing's difficult. Sourcing's complicated with some of these big banks. It's usually long-term relationships, but it's a good industry. And especially right now where we have a complicated, difficult economy, and still it's a rock solid asset class with a lot of good fundamentals.
And if somebody's listening and wondering, hey, am I a good investor for Nick? What's your ideal investor look like?
Sure. We get 2 investment classes, let's say 3, above all else. The 3 people that we most commonly hear from, one, we get from people that are advanced, mature business owners. That might mean they're positioning to sell. It might mean they just sold their business, or that they're thinking about that in the future. But let's say someone's just sold their business. They have an income problem, but they don't have a cash problem, right? They're in a situation where they're sitting on maybe millions of dollars, and they're trying to diversify. So they would invest with Saint, they'd invest with a couple other groups. And what that does is get them cash flow, because they used to have a, whatever, industrial supply company. And this is a deal we just closed recently. And now what they're dealing with is a situation where they don't have the cash flow, but they're sitting on a mountain of cash. That's a very common one. Another is we have a compounding option, which works really well for IRA investors, particularly. So they have a tax advantage structure. They have a strategy with their portfolio that they can go through with their people. And we kind of bolt on really well with that. So IRA side's very common. And then we deal with a lot of what we call tired landlords. That's similar to the business, the business sale idea. And it's landlords that have been doing it themselves. And you've probably seen this, Roger, that historically, if you went and bought real estate on your own and you purchased the property, typically you got higher returns than if you went and invested with another group or another fund. That's historic real estate. That's historic real estate investing. We don't see that as much today. We see that the bigger groups typically have access to bigger product, or to better product, bigger returns with that better product. They can buy more in bulk or buy bigger assets that, the average investor can't. So what we've seen is a lot of investors realize this and realize that it's probably a strategic time to sell depending on their market. And so we'll see them starting to go away from the landlording game and want to move towards the passive investor game. So between those 3 buckets, that's the vast majority of what our investment, sure, 50 grand. 50,000, we try to make it pretty accessible for accredited investors. So 50,000 we find is not really holding up our investor base.
Okay. All 50 states?
All 50 states. US
And
only though. US only
yeah.
though. We, the international thing is they don't make it easy. And so we stick to the US. My favorite.
So basically it's a Reg D offering.
That's right.
And so somebody would sign whatever the stuff was and you'd send them a big fat PPM.
Yep. Exactly right.
Do most of your investors come directly to you, or are they working through another advisor?
Pretty much directly through us the majority of the time. We find it's always interesting because if investors have an advisor, which we always say that's great, run everything by your advisor, run through your accountant, run it through your attorney, run it through everybody, right? But we just find a lot of advisors have considerations where they don't want to lose AUMs. You're right. They don't want to take money off their books and hand it to a different group. So it's, sometimes there's a bias. We bump into different strategies that an advisor
Yeah.
might want to keep things in house. And we respect that. If they trust their advisor and that's a good fit for them, then we encourage them to follow that advice. That's for sure.
Uh-huh. Uh-huh. All right. I mean, I'm sure we could talk for another 2.5 hours if we both had it. And I think I have the feeling, Nick, that we sort of just scratched the surface.
I love this industry, but like you said, it's a mountain. There's a ton.
So, in the scheme of what we can do here in a half hour, what would you like to talk about, like the listeners to know that I haven't given you a chance to talk about yet?
So I geek out on the economic side, and we end up doing monthly webinars, sometimes twice a month, depending on what we're looking at. But we go through the biggest economic topics that we're seeing, the biggest long-term trends that we're seeing. So we've covered things like the 75 trillion that the baby boomer generation will be passing down over the next couple decades. We've covered very interesting geopolitics. We've covered the Federal Reserve and the $2 trillion a year deficit that we're dealing with as a country and the breakdown and the split. The number one most interesting economic trend that I'm seeing today is the stock market shrinking. And nobody's really talking about it. And that's kind of the weirdest, little alarming piece that I've seen. But in a gist, the gist of it, Roger, is that from 1995 until today, so about 30 years, we're seeing that the stock market has retreated, contracted, and lost roughly 45% of its companies. So a massive reduction in the number of companies that are public in the United States and in the New York Stock Exchange and that want to go public, because there's more companies than ever. So we're not saying there's less companies in the US. The issue is that the incentives and the interest in going public and staying public have reduced dramatically. So what we've seen and what we've been concerned with has been a lack of diversification, where we're seeing now it's the most concentrated stock market we've ever had in history, where the top 10% of companies represent over 75% of market value. That's what I'm looking at. I think it's incentives on both sides of the fence. I think it's incentives internally within the company, and I think it's incentives, externally in the stock market. I'll say internally, first off, private equity has really messed it up for the stock market. Private equity has increased the number of companies with private equity backing by 6x during that period of time. So while the stock market's down 45%, it's up 6x on the private equity side. That's interesting, because if you look at the perspective of a business owner, why would they do that? Well, we could go through the obvious ones. Maybe there's heavy regulations in the stock market and they don't want to deal with that. They don't want to deal with the risks. Maybe it's a little bit of there was a whole era of corporate raiders and corporate vultures where founders were ousted from their own companies in the stock market. But I believe one of the biggest reasons is that companies that go from, like, let's say mid-size and want to blow up to a really big market cap, market value, private equity steps in almost as a partner, right? Almost as the angel investor, or almost as the, investor that can really bring them to the next level with a lot of the private equity resources. So the incentives are pretty overwhelming internally at the company. And then that's not even to mention the fact that externally they have to deal with pressures like short-term strategies, right? It's hard to run a company in the stock market and be thinking a decade out when, if you don't meet your quarterly earnings a few times, you got bad things going on and being discussed. So I think the culture in the stock market, I have concern there. I have a concern for how overly weighted private investing has become. And I mean, that's why I'm a huge fan of real estate and small business in general in the US, is because I think it's the great equalizer in the investment markets today. So that's kind of my take overall on it. I have tons of numbers and breakdowns of it, but that's kind of the overview that I'm seeing right now.
Yeah. Nick, where can the audience go to learn more about you, about Saint?
Sure. Well, we got a great chance to talk about how we invest and what we're looking at today for our own investments. But I'd say the best free resources we have are at saintinvestment.com/resources. We do all kinds of deep dives on the economy, on investment strategies that are going on that we're seeing as successful, all kinds of analysis across the board. We give all that away for free. We're already doing the work. So that's saintinvestment.com/resources.
Terrific. All right. Well, thank you so much for being our guest, Nic.
Yeah, I had a blast, Roger, and I'll send you those case studies. I want you to check it out. We can dive in after.
All right. Thank you.
Thank you for listening to another episode of Sterling Insights, Stand Out and Supercharge Your Assets, where we provide the info you need from successful leading financial advisors, lawyers, and CPAs. Your hosts, Roger and Catherine Silk, invite you to learn more about Sterling Foundation Management by visiting sterlingfoundations.com.